All right, welcome to this explainer. Today, we're putting on our sell-side equity analyst hats to rigorously decode the true intrinsic value of supermicrocomputer. And we're doing this based strictly on its financial tear sheet. I am super excited to walk you through this. There is really nothing quite like taking raw data, applying fundamental valuation models, and uncovering the true story that's hiding just beneath the numbers. Let's get right into it. Here is our roadmap. We're going to tackle the SMCI valuation setup, assess the raw data, run through relative and absolute valuation models, look at asset-based and missing models, and finally, deliver our analyst verdict. Section 1, the SMCI valuation setup, understanding the baseline and price action. Okay, so we have to talk about the absolute dramatic tension surrounding SMCI right now because it sets up the core paradox we're trying to solve today. The stock has delivered an explosive 905% return over a 5-year period. I mean, that is just monumental growth. But at the same time, it currently sits down over 43% from its 52-week high of $62.36. As analysts, when we see extreme historic highs clashing with a recent massive drawdown like this, we know for sure there's a severe disconnect between past performance and future expectations. Our job? Find out which side is right. Moving on to Section 2, assessing the raw data, identifying clues, and stating our analyst assumptions. Before we even think about running any valuation models, we gotta look at the operating reality of the business. And right away, we hit a major red flag: significant margin compression. The drop from a 3-year average gross profit margin of 14.13% down to just 10.57% currently is a massive clue. Basically, it tells us that recent capital just isn't generating the same returns it used to. And actually, we see this completely corroborated by the return on invested capital, or ROIC, which has plummeted to 8.94%. That's down over 55% from its 3-year average. This margin squeeze is the absolutely crucial context for our entire valuation. Now, as rigorous analysts, we have to be totally transparent. Because our tier sheet lacks full financial statements, like a complete balance sheet or segment breakdowns, we have to explicitly declare some standard external assumptions to bridge the gaps in our models. To calculate intrinsic value, we're going to assume a weighted average cost of capital, the WACC, of 10 to 12%, which is pretty standard for high-growth tech hardware. We'll also use a sensible 2 to 3% terminal growth rate. And for our relative models, we'll assume a peer group of publicly traded AI server and hardware comparables. Setting these baselines up front is exactly how professionals handle missing data. That brings us to Section 3, relative valuation models, pricing SMCI against market expectations. Let's look at the multiples to see how the market is actually pricing SMCI's earnings and assets right now. We've got a trailing price-to-earnings ratio of 27, an enterprise value to EBITDA of 19.79, and a price-to-book of 3.03. Now, while we don't have listed peers directly in our source documents, we would normally weigh these against that assumed hardware peer group we just talked about. At a glance, though, an EV to EBITDA of nearly 20 suggests the market is still pricing in quite a premium for operations, even with the recent drop in the stock price. But here is where it gets absolutely wild. Look at the sharp drop in these valuation multiples. A forward PE of 1093 implies the market is pricing in massive future earnings growth. Just think about that for a second. You are paying 27 times last year's earnings, but only about 11 times next year's expected earnings. The market expects SMCI to literally grow its way out of its current valuation, completely shaking off that severe margin squeeze we identified earlier. This is the bullish relative argument perfectly visualized. Section 4, absolute valuation models, finding the intrinsic cash flow value. All right, let's leave relative market sentiment behind for a minute and roll up our sleeves for absolute valuation. We want to find the core intrinsic value based strictly on cold, hard cash flows. To build our discounted cash flow model, the DCF, we start with the reported $440 million in trailing free cash flow. Step 2 is modeling out future growth. Our data shows a massive 5-year free cash flow compound annual growth rate of 84.56%. But honestly, applying that blindly into the future is incredibly dangerous given the falling ROIC we already talked about. Finally, step 3, we discount those projected cash flows back to today's value using our assumed 10 to 12% WAC. This tells us what the core business is truly worth today. Now, because DCF inputs can get really noisy, dealing with 84% historical cash flow growth alongside shrinking current margins is tough. We look for alternative absolute models. We could theoretically run a residual income model. This approach takes the provided return on equity of 12.48% and the price-to-book ratio of 3.03 to estimate the equity charge. The residual income model is highly robust because it grounds the valuation in the actual book value of the equity today, rather than relying purely on speculative cash flows a decade out. So, what's the bottom line here? After crunching the absolute earnings data, the source material actually provides a finalized fair value price for us, $35.99. This is derived directly from an absolute valuation model based on earnings per share. It takes all that noise, the 62% 5-year EPS growth rate battling against the recent 39% trailing 12-month net income drop, and distills it all down into one single intrinsic fair value target. Section 5. Asset-based and missing models. What the data doesn't tell us.
Part of being a rigorous analyst is knowing what you can't model. So let's be upfront about our limitations. There are certain models we simply have to skip. For instance, we completely bypass the dividend discount model, or DDM, because SMCI pays 0 dividends. Its trailing dividend CAGR is literally 0%. We skip the sum of the parts valuation, because the tier sheet doesn't break out distinct business segments or segment-specific cash flows to value independently. And finally, an adjusted present value model, which separately values operations and debt tax shields, is limited because we just lack the granular liability details required.
But we do have one really incredible metric for an asset-based view. This enterprise value to assets ratio of 0.77 is fascinating. It essentially tells us the market is currently valuing the firm's operations below their gross asset replacement cost. Think about it. When a company trades at an EV to assets ratio under 1, it implies the market is heavily discounting the company's ability to utilize its assets efficiently. And frankly, given that return on assets has dropped 51% compared to its trailing average, the market might be completely justified in pricing in that discount. And that brings us to Section 6, Final Analyst Verdict, synthesizing the data into a conclusion. We've gathered our clues, laid out our assumptions, and run the gauntlet. Now it's time for our final synthesis. This valuation football field concisely summarizes our findings. The last close price of $35.37 is trading almost exactly in line with the $35.99 intrinsic value we calculated from the absolute EPS model. So what does that actually mean? It means there is a razor-thin 1.72% margin of safety. According to the absolute fundamentals in this tier sheet, the stock is currently perfectly priced. It is neither deeply undervalued nor wildly overvalued right now. So I want to leave you with this final thought as you digest this explainer. As an investor, looking at this raw data, do you trust those low forward multiples that promise massive future earnings? Or do you fear the clearly shrinking profit margins and plummeting returns on capital? The data lays out both paths perfectly, but the ultimate verdict on where the company goes next? Well, that's up to you. Thank you so much for joining me on this deep dive. Keep asking hard questions, keep looking closely at the fundamentals, and I will see you in the next explainer.